Hello, I'm Sam Stovall, U.S. equity strategist for S&P Capital IQ. In this week's Sector Watch, we discuss the performance of high-yielding stocks after the stronger-than-expected January jobs report. As a result of the robust January jobs report, investors seem to accelerate their own timetable as to when the Fed will begin raising rates. While the S&P 500 slipped 0.33% on Friday, February 6th, U.S. REITs fell by 3%, and the Barclays 20-plus year Treasury Index slumped by nearly 2%. In addition, 9 of the 10 worst-performing S&P 500 sub-industries, which dropped between 3% and 4.5%, yielded more than the S&P 500. The conclusion of this one-day performance for high-yielding investment implies that when the U.S. Federal Reserve does finally start raising its benchmark Fed funds rate in June, don't be surprised to see the long-term high-yielding outperformers finally take it on the chin. That doesn't necessarily mean that investors should be bailing out of these issues. However, we at S&P Capital IQ advise investors to be choosy when searching for higher-yielding issues. In this week's Sector Watch report, found on S&P's MarketScope Advisor, I list 10 stocks that 1. Yielded 2% or more, 2. Were ranked buy or strong buy by S&P Capital IQ equity analysts, and 3. Had a beta of 1.0 or less, showing a lower price volatility than the market as a whole, and finally, that carry S&P quality rankings of A-, A, or A+, demonstrating an above-average consistency of raising earnings and dividends in each of the last 10 years. I'm Sam Stovall, and I'll talk with you again next week.